USO, otherwise known as the United States Oil Fund, has seen an incredible rise in popularity among retail investors. With the oil market in its most volatile state maybe ever, this ticker has been all over the news, even trending on Twitter at one point. While not technically a stock, USO in simple terms is an ETP that seeks to provide investment results corresponding to the daily price movements of West Texas Intermediate. In simple terms, it's a ticker you buy that will try to replicate the price of oil, specifically WTI. Many people, including myself, got caught in a violent spin cycle that left retail investors confused and exposed. The coronavirus and the Russia-Saudi price war caused oil prices to plummet. Just as advertised, USO plummeted as well, tracking prices nearly perfectly. Knowing oil would eventually rebound, many investors bought USO as a way to catch the bounce in the oil markets, knowing that the commodity would eventually go up. But investors failed to understand what it was they were actually investing in. You see, USO seeks to provide investment results corresponding to the daily price movements of WTI oil. The key word there is seeks. The fund has been around since 2006 and has been quite good at tracking the price, but in recent weeks its flaws were made obvious and it cost a lot of people their portfolio. To understand this, you have to comprehend how USO actually tracks the oil price. It does so by buying into near-month future contracts on WTI crude. This may sound confusing, but I'll give you a quick example. Let's say it's March 15th. USO would invest its money into April WTI futures. These future prices typically match the current WTI price and any movements they experience. At a certain point, as we move towards April, USO will quote-unquote roll or sell their April futures and buy up May futures. This cycle continues forever and ever, and is usually a pretty good way of tracking the price of oil without actually holding and selling the physical commodity itself. There is, however, one big issue with this, and it comes in the form of two key words: Contango and negative roll yield. Contango occurs when the current price of WTI oil is cheaper than the future price of WTI oil. This is actually happening now, and I can explain. Investors are aware of the virus and price war, and they know things will eventually pass. This means future prices are reflecting that. The April WTI future price is $16, while the July price is $24. So why does this matter? Well, since the front month future contracts are cheaper than those expiring further out in time, the futures curve is set to be upward sloping. This causes negative roll yields, because USO will lose money when selling the future contracts that are expiring and purchasing further dated contracts at a higher price. In essence, going back to what I originally said, when they roll, they will lose. This compounds over time and causes wild variations between USO's price and the actual price of oil. You can see this with this chart where WTI in blue is down about 20% from 1 month ago. Meanwhile, USO, which is supposed to track its price perfectly, is down about 50%, nearly 3 times more. This is a clear example of negative yield roll. Investors can be easily tricked. Take a look at last year between WTI's actual price and USO's price. It tracks extremely well until these last 2 weeks. Unfortunately, in periods of wild volatility, USO is a poor investment. If you're looking to long oil, a better bet is an established oil company like most years you don't have to worry about negative roll yield and Contango. Every now and then, these issues come up and ruin your investment. This is why you should invest in Exxon, Chevron, and BP and other established companies instead of an ETF like USO. Thank you guys for watching, and make sure you hit that subscribe button if you enjoyed, and comment below if you were caught in this wild USO roller coaster that left a lot of people broke.